Good morning. Welcome to the morning market briefing. Today is Thursday, Burrito Day, February 5th, 2026. Underrated tomorrow is 2626. So obviously, get ready to celebrate that. Got a lot to get to today. Ben and Andrew are out. They do an annual presentation for one of our biggest clients. It predates me coming to Narwhal, so I've never been invited to do that. It doesn't hurt my feelings that I never get invited to this particular presentation, and I'm not mad about it. And it would be overkill. I mean, it would just be too much information all at once, I think, so we don't want to overwhelm anybody. So just left here on my own with Hicks to talk about earnings, which a lot of people would say is definitely Ben's job. But let's get into it. Big news, definitely everyone's going to be talking about today is Google earnings, which came out yesterday afternoon. Right now, the stock's down about 5%. And I think the theme here really is that we have entered the era of big numbers. I mean, these numbers are insane when you think about just the amount of money that they're both generating and spending simultaneously in a very short period of time. We're talking about a 90-day period, Q4. So in Q4, their revenue was up 18% year over year for $113 billion. Earnings per share was up to $282, which is a 31% increase, still massive. And they made $400 billion in the year 2025, which was a new record. Just insane. And cloud was up 40%, up to $17 billion. I mean, these are massive numbers that people don't even really seem to notice anymore. But we've just gotten to an era where these companies are making so much money and they're so big. And wait till we get to CapEx. But other notable things, they're getting up to 400,000 weekly rides on Waymo. So they've just got their hands in a lot of buckets. YouTube, $60 billion in revenue. I mean, there's just massive money flowing around Google. But, you know, even though the numbers are excellent, we're seeing huge growth for Google. You know, the theme we've been talking about the last week or so is capital expenditures. So the big surprise to the upside that people are really worried about is that they gave their guidance for 2026 CapEx in a range of $175 to $185 billion, which is far, far, far above the estimate of $119 billion that analysts had. And so for context there, I mean, I think they hit a new record of $400 billion in 2025. So call it roughly somewhere in the neighborhood of 45 cents for every dollar that they're going to bring in, assuming they do the same amount of 26, is going to be going to reinvest in the company. You know, and their estimate is that 60% of that is going to be going to the AI server infrastructure build out. So think NVIDIA Rubin chips and their in-house TPUs in order to continue the great arms race that is the AI, I guess, landscape right now. And, you know, you think of the numbers. I mean, they're going to be spending money with NVIDIA. Meta's going to be doing that. Amazon's going to be doing that. There's so much money filtering into one company. I tend to think that NVIDIA is really going to be the only big winner here. And at the end of the day, they're very susceptible to the fact that when people start to see that there isn't a return on investment for some of these companies, or they have to cut back, that those numbers are going to come down pretty quickly too. But for context, 175 to 185 billion would be enough to buy the Walt Disney Company. It would be enough to buy Verizon. It would be enough to buy Intel outright. I mean, these are all the companies that are in that range in terms of market cap in the S&P 500 right now. So you could buy some of the biggest, oldest companies in the world. Should Google buy Disney? I'd argue they might do a better job managing it. Verizon, I think, is a melting ice cube and probably going to zero. And Intel might actually be the only one that has synergistic effects, but it seems like they stink at making chips, and so that'd probably be a bad investment as well. So they're just going to give all that money to NVIDIA, it seems. But, you know, there's going to continue to be headlines today. I think if you look at it objectively, if you want to succeed in the AI space, you have to do this. It's an arms race. There is going to be a winner, and these companies are all gunning to be that winner. The question is this money going to actually turn into earnings per share? I mean, if you look at the numbers this year, they spent an enormous amount this year, and they made the most revenue they've ever done. Cloud computing up 40%, which you could argue is AI. You know, the Waymo's 400,000 rides a day, that's all run on the AI infrastructure as well. And so if they can turn those things into profitable ventures, I think that's very good. I mean, I've dabbled a lot with trying to figure out the differences between using Grok or Gemini, ChatGPT. If I had to rank them, I'd probably go Grok, Gemini, ChatGPT in that order in terms of the ones I think are most useful. I've used Gemini a lot. We've looked at different ways to improve the podcast by asking Gemini questions to just assess the podcast, because it can pull everything that's on YouTube, it can pull everything that's on Spotify and give you an idea of what works and what doesn't, and what the dynamic pieces are. So that's very helpful. How much money that actually generates them, I'd be very curious to know. But it's an interesting landscape right now. But just think, we're in the era of big numbers. I mean, if you extrapolate that out over the next 5 years, they're going to spend $1 trillion if they just basically stay flat over the next 5 years, which is, 10 years ago, there were no trillion-dollar companies, and now we've got a bunch of them, and Google is one, I believe, and that's basically the entire market cap they've been able to generate up to, call it, 2020 in a single 5-year period at the rate they're going. It's just unbelievable numbers. Other big news, yesterday we had Scott Bessent testifying in front of Congress, and let me tell you, it was awesome. I think the biggest takeaway is that our thesis that perhaps we've had an employment bubble really showed itself yesterday, because there were a lot of people who were asking questions from the bench who I think would be completely unemployable in any situation. They asked some very dumb questions. They clearly have no idea how to read. They've been given questions to ask Scott Bessent that they clearly had a problem where they got to the end of the line and then there was a hard pause before they got to the next line of dialogue. So it'd be like, oh, you guys said that you were going to, raise interest rates, and then next spring you're going to, and, it's just like I don't know how to read. I've got to really think about how to get to the next line moments. But the big takeaways, I think, is that Scott Bessent is definitely on message. There are a lot of things that I agree with him, and you don't hear a lot of people talking about some themes that we've had discussions about on this call for a long time. I've repeatedly said that it's really not about the legality of people coming over the border. It's the fact that we've had a huge increase in just the number of people demanding the same number of goods and having to compete with them when they're getting free money from the government that has caused inflation. You're printing money, you're giving it to people, they're spending on goods and services. And there was an exchange with Sylvia Garcia, who I believe is a Democrat from Texas, where she was unable to understand Scott Bessent's line of thinking that if you bring in 20 million people, they need somewhere to live. And if you increase the population enough, you're going to very quickly see housing costs go up because they are demanding places to live. And if they're getting government money to pay for those and competing with people who have to work to pay for those, then it really creates a bad demand shift, and that's caused the housing problem. He's basically said there isn't a supply problem, there's a demand problem. There's too many people coming in too quickly in order to satisfy housing needs. So if we, remove that Band-Aid, housing prices would come down. And we've already seen that. We've seen things like, the entire Sun Belt have rent decreases very quickly. We've seen Doritos, or Pepsi, Frito-Lay, saying that they're going to cut prices 15% on snacks. I mean, who do you think was buying these? There's suddenly fewer people buying these, and they're going to have to bring down prices. We've seen the same thing across a number of things. The 4,000 calorie a day is a nice way of saying that the people who were buying Modelo are no longer here. And that's positive for inflation. And, obviously there's some questions about the modality of deporting people who are here illegally and flying them in and giving them money, but that's a real thing. And he's on message there, and I agree with him. And I think that that's right or wrong, whether or not you need to be, amenable to people when they move here and treat them like citizens is beside the point. The problem is the economic impact has been insane. And there are very few people who are discussing it from that rational financial perspective. And he was on message there yesterday as well. Notable takeaways. He's obviously very pro small bank. We've seen massive consolidation. Basically everything is JP Morgan now. He said that we need to be avoiding regulation by reflex and allowing small banks to operate and not just saddle them with insane regulations, because the more small lenders are able to compete with big lenders, the better we are in terms of the momentum that we can get loans done. We've had recent discussions with small business owners here where, they have trouble with small banks where they're getting a better deal to finance business operations. It's taking too long. There's too many hoops to jump through. We can have better growth, faster growth if we can get small banks, regional banks, community banks lending money. But the problem is they've all closed up shop. They've consolidated. They've all rolled up into the big banks. And, you can't get in contact with anybody. You can't have that personal relationship. And he was very adamant that we need to get that back and moving in order to continue to have a functioning society. I mean, if you look at Europe, they regulate everybody through the nose and they have absolutely no growth. We're looking at, a GDP now with a 5 handle. They're celebrating, 0.3% in Europe. That's what you get when you overregulate everyone to the moon. And so I think that he's on message there as well. I'd say the fun one was probably Maxine Waters. They got into a little bit of a spat over whether or not Harriet Tubman should be on the $20 bill and how long that's going to take. She told him to shut up. She asked someone to shut him up. But the problem with the current situation is that Scott Bessent is a market participant. He is an extremely smart person. He is very well read, and historically, he knows history and what's happened with the banking system, with the financial systems, and a lot of these people do not, and it makes them look very dumb. And he is very quick to cut them off the knees. I think the word I read on the Wall Street Journal was pugnacious. But man, he was just killing people left and right yesterday. It was awesome to watch because he's just an absolute operator. And I think back to all of the Treasury secretaries that we've had. Janet Yellen, who basically is a 3-foot tall cartoon duck. Mnuchin, who I don't think did anything as far as I could remember that of note. It didn't seem. I mean, he was there, but I don't remember talking about him or thinking about him at all. And so this is a new age. We're getting real people in real seats, and it's pretty awesome to watch because you're seeing someone who knows what they're talking about, just parrying every dumb attempt to attack him in real time, and it's so satisfying as someone who also participates in market. Other earnings we had today: Qualcomm, down 12%. Similar story where they beat on EPS. Slightly. It wasn't a big deal. Auto seems to be coming back to life for their chips. Handsets up 3%. Auto up 15%. Internet of Things, which I didn't realize we were still doing, up 9%. People may recall that Internet of Things was sort of AI before AI was AI. It was a very hot talking point in like 2012. But the problem here with Qualcomm is they gave soft guidance. They basically said, we're seeing revenues in the 10.2 to 11 billion range. The estimate was for 11.15 billion. They gave a stark warning that there's a real shortage in DRAM chips. They're basically getting diverted away from smartphones and handsets and going to make up capacity problems for AI. But they did note that they're launching a new segment of their business, which has a real cool name, Dragonwing, which is going to be the new platform for robots and humanoids. I'm not real sure what the difference is, other than I guess a robot is a robot and a humanoid is a robot shaped like a human. So I guess we'll find out what that looks like. But the stock's getting beat up on that. And I think that there are a lot of shorts and there are a lot of people getting out of the tech space right now. And I think that I don't know when this ends, but what's interesting is that, there's been a lot of fears about, the S&P 500 is really overweight from a PE standpoint. But if you look at the P's are all coming down and the E's are all going up. So you could argue that Google is actually much more valuable today than it was yesterday because they had a massive increase in earnings per share and the price of the shares is coming down. They made a ton more money this year than they ever have in the past. The problem is people are concerned that they're going to spend a lot more money. Qualcomm's going to spend a lot more money, and this whole space is completely saturated with money spending, and someone's got to turn around and make money on it. And until they do, I think people are going to continue to be fearful that we're throwing a lot of money into the abyss. And I think that there's definitely some understanding there that could be true. It just remains to be seen. Other notable earnings, and I'm going to put a little feather in my own cap here, but Tapestry, which is the parent company of Kate Spade and Coach, real men invest in purse bonds, but they're up 8% today. They absolutely crushed it. Coach was up 25%. Kate Spade did well, but they're basically looking to get it in line with Coach and really push the ball forward there. But their earnings per share were $2.69 versus an estimate of $2.19. So they're just absolutely rocketing. They did a ton of buybacks. You may recall, we talked about on this call, they tried to buy Capri, which is the parent company of Michael Kors and Versace. They raised some debt to do that, but basically the government started looking into it, said, hey, maybe there's a little bit of antitrust here. And so they squashed that. They redeemed those bonds. They funneled that money back into buybacks, and they are just cleaning up that balance sheet, which is what you want to see when you're buying bonds. And we own them. I think we own the 31s and the 32s. And man, those things have performed like a dream. I'm very happy with that. You could argue that some of that is rates coming down. Some of that is spreads tightening, but we own those things for the long haul, and they were very, very cheap when we bought them. And so I'm just, want to make sure we highlight that we do monitor the companies we own bonds for as well. Final piece, let's see, we've got Washington Post firing a third of their staff. I mean, I think they basically Bud Lighted there, which is they had a very adamant, sort of left-leaning group of people who subscribed to the Washington Post, and Jeff Bezos basically said, hey, we're going to move this back towards the center, and people stopped subscribing, and now they're cutting a third of their staff, which is wild because the Washington Post employed 900 people, which seems like a lot of jobs for one newspaper in Washington, but that's just my opinion. And then other things to note, Trump had an excellent, quote, excellent call with President Xi. They're estimated to buy, I guess they've agreed to buy $25 billion in soybeans in the next season. I'm not sure what that timeline is, but I'm assuming soybean season is probably sometime in the next 6 months. And they're moving forward with airplane deliveries. He's reducing the ICE headcount in Minneapolis, which I think is good for optics. You might as well go where people are more embracing of law enforcement. So that'll definitely help if they take those people and put them somewhere where we can continue to get inflation down based on how that works, which I previously talked about. And I'm trying to think what else there is to talk about. There was an article this morning, and we'll probably talk about this more next week, but we've talked a lot about the private credit space, but there's an article saying that BlackRock had functionally sold $15 billion in private credit to itself in order to redeem people out of their other funds. So basically, we've talked about how they have these gates in place where you can only get so much money out of their funds at a certain time. Well, in order to facilitate that, say I start fund one, I buy all this private debt, I put it in there and you're invested, but you want to get out. What Blackstone has essentially done is say, hey, now we have fund two, and they get a bunch of people excited to invest in fund two, and all they're doing is buying the assets out of fund one to get the guy out, which, stop me if you heard this before, but is a little Ponzi schemey, if you ask me, because it's privately traded, and so the price is whatever someone is willing to buy it for. So you get guy one out for a slight gain by selling his assets to guy two. Guy two now has a higher level where he's getting a worse yield, and it's not like people are getting more excited to get from private credit. So the question is, at what point can you stop moving the hot potato down the road, and then guy three, maybe guy four takes a massive bath on it? So that remains to be seen. But we've been on this for a couple of years now, where private credit is not what you think it is, and probably shouldn't be included in your pension or in your 401k. But we'll see how that turns out. But I'm not feeling great about it. And with that, I think we will wrap up. But as always, like, subscribe, leave us a comment on all the platforms, YouTube, Spotify, wherever you find us. And if you have questions, concerns, particularly if they involve a dollar sign, please feel free to reach out and we will cover it on the call or point you in the right direction. And we'll see you tomorrow.